Welcome to the Plan Solutions Incorporated podcast. We'll be speaking with President of Plan Solutions, Chase Armour. I am Jason LaChance, and we'll be taking you through this wonderful conversation on some great topics. We're going to touch on financial stress index. We'll discuss what it is and how it relates to regional banks and large money banks. Also, take a look at insider stock transaction, and we'll discuss what kind of a signal this is for stock performance, if it's a positive or a negative. Also, we'll take a look at periodic review of estate planning documents, and what do you and should you review. Also, we got two items pinned up on the Plan Solutions Incorporated office bulletin board that we'll discuss. And thank you for listening to the podcast. If it's your first time, hit subscribe on whatever platform you're listening on, be it Apple Podcasts, Spotify. Leave us a rating and review, and we're now available on YouTube. If you go to YouTube and search Plan Solutions, you'll find the podcast there. And hey, please subscribe, leave a thumb up, maybe some comments or questions in the section that we can review and maybe incorporate into a future episode. And if you want to subscribe to the Personal Financial Review, send Katie an email at Plan Solutions. That's Katie at plansolutions.com. Mr. Armour, how are we, good sir?
Doing good. It's the last stretch of tax season, so busy. If anyone's listening to this podcast and they haven't got their tax stuff in, you better get moving. Running out of time.
Yes, sir. Well, we got some great topics in the Personal Financial Review, so let's dive right into financial stress index. I want to know a little bit more on exactly what the financial stress index is and maybe how it's gauged and calculated.
Yeah, so really this was something that came out of the financial crisis, right? When there's a new need, then you develop new tools to monitor things. And it's really designed to measure the stress or the challenges or the dislocations that are happening within the overall financial system. So basically, financial stress index of 0 means there's not really a whole lot going on. As it starts to go into positive territory, typically happens during recessions, obviously, really peaked during the financial crisis. So it's a signal that there's some real issues going on with the financial system, probably, challenges in terms of, bankruptcies, solvencies and things within different institutions. And also, that is going to flow through and affect their willingness to lend or to lend at reasonable rates. So it definitely has a ripple effect through the economy. Meanwhile, when, it's a negative territory, it means stress is very low and things are running fairly smoothly. Companies are continuing to do the normal things that they do in terms of taking deposits and issuing credit and are not really facing any big financial challenges.
Okay. Thank you for the clarification. And you start off talking first and foremost about Silicon Valley Bank and that failure last year. So it really sets what you're trying to display here of, the regional bank versus the larger bank, so to speak, or what's the term that was used? Too big to fail banks. So how does that really play into what we want to talk here about the financial stress index?
Yeah, that too big to fail term that came out of the financial crisis is still with us for sure. But yeah, it started kind of referencing the Silicon Valley Bank failure because it was about a year ago. And that was, we talked about the financial stress index back then as we kind of tracked how that was progressing and if it was going to turn into something bigger, if it was going to ripple through, beyond regional banks into other areas of the financial system. I mean, those were all concerns at that time. So it felt like, a year later, it's a good thing to revisit and kind of see how have things played out. Altogether, it's pretty positive. I mean, the financial stress index is, it moved from negative territory last year into positive territory. Obviously, the stress on the financial system went up when several regional banks failed, and that kind of rippled into other areas of the market. But all in all, now that we're through that period and looking back, okay, a financial stress index of 1.2. Obviously, it moved positive and it moved up quite a bit in a short time period, but pretty small compared to what we'd seen in the previous difficult periods, right? We had the financial stress index. The highest we've seen it was 9.42 during the financial crisis. During the peak of COVID, it hit 5.22. So there was definitely some bigger challenges. What we faced last year was really kind of just ended up being a fairly small bump in the road, at least for the financial industry as a whole.
Mm, mm. Now, does this mean that being that we're in positive territory? I mean, we really pinpoint March of 2023 with the 5.2 in the negative. Does this mean that all areas have recovered, or we've talked a lot about inflation and interest rates and how they're impacting, and I'm sure the regional banks that a lot of their revenue is off of lending when people maybe aren't wanting to get a home loan or a car loan or whatever it is, are still being impacted.
Yeah. The financial stress index is measuring the industry as a whole. So when it moved up last year, it really was more focused on regional banks and didn't really spread beyond that, which is why it was so short-lived and arguably the financial stress index never really got that high. But now that things have normalized, we're seeing that doesn't mean that all areas of the financial system have seen the financial stress, fully abate from what we saw last year. The large money center banks, or as you said, the too big to fail banks, actually were big beneficiaries of that. They really thrived during the regional bank challenges last year. A lot of households and businesses started shifting their banking relationship from these smaller regional banks that maybe were headquartered in their communities to these larger financial center banks headquartered in New York or some other financial center, because they were worried about the solvency of the bank, and maybe that meant less of a relationship banking type situation, or even less money that they would earn on those reserves. But they did it out of an abundance of caution in terms of the risk. Meanwhile, regional banks have continued to struggle under several negative pressures. The first is the loss of those low cost deposits, right? Typically that's the lowest cost access to money that banks can get is our deposits, the money we have in our checking and savings accounts from, day to day. And so when that money flowed out and went to their larger competitors, they had to go to higher cost sources of capital. So it increases their interest expenses to get access to that money. The other challenge is that a lot of regional banks really focus on commercial real estate lending. That tends to be more of a local relationship-based business. And so, these regional banks located in certain communities build those relationships and do more of that type of business. But as we know, since COVID, commercial real estate has struggled as vacancies, especially for office space, have increased. So there's less cash flow available to the landlords. Makes it more difficult for them to be able to make their loan payments. The value of the real estate that's used as collateral on those loans has decreased and by quite a bit in certain markets. So in some cases, the landlords, might even stop paying on the loans and in effect give the property back to the banks. For the banks, that can, create the transaction costs as they attempt to sell those properties. They might be selling into a depressed market, so they may not even be able to sell for as much as they're owed. So that could lead to losses. So there's just a lot of challenges there that they're still dealing with as we're still kind of dealing with the tail end of some of the changes in society that occurred during the COVID pandemic.
Yeah. Well, and how has some of those regional banks combated some of that?
Well, we've seen a big shakeup. Obviously, some banks didn't make it, right? Some banks failed, but a lot of others, we've seen a spat of mergers, a number of regional banks merging to try and consolidate costs and get larger. And a lot of times in the banking industry, scale can be very valuable. They've also done some different things to try to bring those deposits back, lower their borrowing costs, et cetera. And then in a lot of cases, with the commercial real estate loans, they've been restructuring loans, trying to kind of, kick the can down the road, hoping that the market and the cash flow and the value of those properties recovers, so that they're not having to recognize those costs or losses now, but maybe, can kind of spread them out over time or allow the market to recover to avoid having to take that hit.
Yeah. So overall, To sum it up, financial stress index low. This is a good sign.
Yeah. I mean, the regional banks have really been highlighted because of all the challenges we just talked about. But the big picture is that the overall stress index is really, really low. I mean, it's basically at record lows, which bodes well for the economy. It says the financial system as a whole is healthy. It's able to efficiently and effectively allocate capital to businesses and households that are willing and qualified to borrow, as well as processing transactions and being a reasonably secure place to hold short-term financial reserves. So I think big picture, yeah, still looks very positive. Obviously, it could be a little bit better in certain pockets, but you could pretty much say that about any time period.
Yeah. All right. Well, let's jump into insider stock transaction as a market signal. Now, to differentiate, when I first read this, and I went, "Wait, insider trading? No, this is an insider trading, insider stock transaction, which happens frequently. But it's really pretty interesting how you laid it out, and I just kind of want to throw in really what it is first and foremost, so people understand the difference between insider stock transaction and insider trading."
Right. Yeah. Insider trading is illegal, right? That's if you have insider information or non-public information, and you're not following the procedures to be able to buy and sell stock, right? There's certain restrictions that are in place, and including that if you are an insider, you have to be registered as an insider so that they can make sure that you're following those rules. Where people get in trouble is if they're an insider and they're not trading under the rules, or if they are not considered a quote unquote insider of a company, but they have inside information that they got from somewhere and they're trading on that information, that would be illegal. But in this case, we're looking at company insiders. So basically the directors, the people that have significant material information about a company and thus its stock, based on their position in the company and their job responsibilities. And so they are registered as insiders, and anytime they buy or sell, that's public information. So you can go through and track are people buying or selling. And some people like to use that as a market signal, right? Mm-hmm. Are insiders positive or negative? And we bring this up because I've had a number of people ask that, there's been some large amounts of insider selling. Mm-hmm. Where company directors or founders are going in and selling large chunks of stock. And some people have said, oh, that must be a really negative sign for the stock market and for those companies in particular, because, why would the insiders be selling so much if they thought the company's stock price was going to do well?
Sure.
And so what we're pointing out here is that if you look at it historically, insider selling has rarely been a reliable signal of future stock performance. And the reason is there's a lot of reasons that insiders might sell, right? They might need to sell to cover taxes on stock grants. Maybe they're planning on making major purchases, right? At some point, as you accumulate wealth in these companies, you're going to want to liquidate some of it to actually benefit from it. So that may be major purchases and maybe big charitable donations, who knows? Or just for diversification, right? Sure. I mean, just like anyone else, if you have a huge percentage of your wealth in one stock, that's very risky. And at times you need to go in and diversify to lower that risk.
Yeah, I remember several instances in the news, and the one that stands out the most is when Howard Stern had sold a good portion of his Sirius XM stock, and there was all this hoopla and stuff around it, and it was simply, as you were saying, he was doing some restructuring, wanted money to go here, there. So it's pretty interesting how people jump to the negative conclusion first and foremost.
Yeah. And in that case, he had signed this really big contract and was paid in stock, right? He wasn't paid in cash. So really he was just saying, okay, fine, you want to pay me in stock, then I'll sell the stock, and I'll do whatever I was going to do with it. But yeah, another one that, recently was Jeff Bezos had some really big sales of Amazon, right? Mm-hmm. Well, obviously he's been, doing a lot of different things with that money now that he's basically retired from the day-to-day operations. Including a lot of charitable, commitments and things. So he, that's where that money has to come from in terms of liquidating. So, looking at why insiders are selling now, has been part of the question, right? Okay, so fine. So they're selling, there's a lot of reasons they might be selling, but why now? And I think really it's just a reflection of what the stock market has done, right? I
Hmm.
mean, we saw, recently we saw a big dip in 2022. In January of this year, at least for the S&P 500, it had made a full recovery from those losses. Obviously, if you're an insider over the past 2 years, you were probably very hesitant to sell while your stock price was down. And now that it's recovered or maybe even going on to hitting new highs, they probably look at it, okay, this is the time to start to liquidate some of that to have more available cash, which maybe they felt like they didn't have over the last 2 years because, they were being more cautious and not wanting to sell while prices were down. So it's probably just a reflection of the fact that the market is recovered and now is a good opportunity for that to happen. And so I don't really think it's any big negative sign for the stock market. And so far this year, with what we've seen in stock prices, a lot of those big sales have not really impacted the performance of the companies. But I think on the other hand, something to keep in mind is when there's insider buying, that's typically a positive signal.
Mm.
And the reason is, as we talked about, there's lots of reasons to sell stock. There's really only one reason to buy it, and that's because you think it's going to go up. You think you think that you'll profit from it. And so what's been lost a little bit is we've seen a number of industries where insiders have been buying a fair amount of their company stock, which indicates they think that stock is still underpriced and will likely to increase in value over time. So I think looking at the insider buying and selling transactions, you have to take the selling kind of with a grain of salt. It's not really the negative signal that maybe the financial media has made it out to be in recent months. And then meanwhile, they've kind of glossed over the insider buying, which really is a positive signal, and that should be given a lot more weight.
Yeah. Well, and I think this goes back to something that you've reiterated a few times here on the podcast is we got to look beyond the headline.
Yeah. The headline, I think a lot of times it's, they're looking for kind of the extreme reaction, right? That's what gets clicks. That's what gets people to click on the article and read through and see the ads that are on the side. And that's how they make money. So you can get these more sensationalist claims and things, and you have to kind of think it through or do the research and back test it and say, okay, they're saying there's this relationship. Insider selling leads to poor stock performance. Let's go see if that actually holds over time. And if you did that analysis, you'd find that that's not really a valid claim.
Yeah. All right. Let's jump into periodic review of estate planning documents. And we've touched on this recently that estate and tax laws are constantly changing, sometimes requiring updates to existing estate plans. And this isn't always a situation where you want to set it and forget it.
Yeah, it is something that should be reviewed every so often. Really two major reasons, right? As you said, change in estate planning laws, right? That may change what you want the overall strategy to be, so that it works as efficiently as possible, or in some cases, so it minimizes costs, the administrative costs as much as possible. And then the other reason is that people's goals change or their objectives of what they're trying to accomplish. In the end, the goal of an estate plan is to transfer an individual's assets, effectively and tax efficiently to their desired beneficiaries, whether that's an individual or a charity or whatever it may be. And the way you do that is by, setting up these estate planning documents that basically lay out the procedure that you want done to make that happen. So it's a combination of, the current tax law, and legal strategies, as well as just the personal goals or personal beliefs of the individual. And over time, all three of those things can change. I mean, we've seen estate laws change. We've definitely seen tax laws change periodically. And, most people, when I talk to them, their views change or what they want to accomplish changes. So for that reason, it's just really important that every so many years to, review the estate plan, maybe meet with the attorney that drafted it, say, are there any changes? Are there any amendments that need to be done? And then once you do, go to that next step of then making sure any beneficiary designations and things like that on other types of accounts are in line with the overall plan so that everything works really smoothly.
Yeah, well, and then there's really several areas that you point out that people want to really take a look at: wills, trusts, financial powers of attorney, and healthcare powers of attorney, which is something that isn't always brought up as well.
That's a great point. Yeah, that is one that usually people don't think about, right? They're thinking about their assets and not necessarily who might be making healthcare decisions on their behalf, and that's something that could change over time. Just as family dynamics change, people get older, maybe, someone that you had designated before isn't really in a position to be able to take on that responsibility. And you should be, thinking who might be next in line or a better person to fulfill that responsibility.
Absolutely. All right, Mr. Armour. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. You have 2 items pinned up there. Let's start with the first one.
Yeah, so as we discussed at the opening, tax deadline is not far away, right? We're counting down the days now, and this year, it's April 15th. There is no extension for the federally declared disaster areas or anything that we had last year. So what a lot of people don't realize is you can file for an extension. And it gives you an extension of time to file your tax return. It gives you 6 months, so you'd have until October 16th this year if you filed for an extension. But it is not an extension of time to pay the tax that may be due. And so if you're going on extension, really what you have to do is gather as much of the information as possible, make estimates about the information that you don't have, so that you can determine that if you do owe, you can go ahead and make a payment when you file for that extension. Because if you don't do that and you wait and you file the tax return later after the April 15th deadline, you could be subject to a late payment penalty and also interest on the amount that's owed. And then right now, with interest rates being fairly high, the IRS is charging 8%. So it's an 8% per year interest rate, but it compounds daily, and obviously that's a pretty high interest rate that can really add up. And then of course, you could add penalties on there, which can add up to 0.5% per month in addition, in the form of a late payment penalty. So you could end up paying 4 to 8% more in October on whatever that balance due may be if you haven't done the proper planning, leading up to April 15th.
Yes, sir. All right, well, let's take a look at that second item pinned up concerning Charles Schwab.
Yeah, so Charles Schwab and actually a lot of other custodians recently issued corrected 1099s, typically for taxable or basically non-retirement accounts. In the past, these corrections have been pretty small, so in many cases they didn't necessarily require an amendment. And in the past, they didn't come out quite this late, so it's probably maybe capturing a lot of people by surprise. But if you do get a corrected 1099, this year it seems like I'm seeing some larger corrections, so it is something worth reviewing. I know our plan is to circle back after the April 15th deadline and go look at all of those corrected 1099s. If it is for a tax return that we filed earlier in the year, run the numbers and see if it does create a large enough correction that we're going to go through and amend those returns to get that extra refund. But for anyone else, or if we don't prepare the return, it's probably something to keep an eye on. See if you can file a superseded return, which is kind of an easier way of doing an amendment, but you have to do it before the April 15th deadline, or to do an amended return, which also isn't really that difficult. But if those changes in the dividends or interest reported are significant enough so that they've reduced and you're in a high tax rate, you could see a situation where you could save $100 or $200.
Mr. Armour, anything else you would like to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, I know by the time this podcast comes out, we're going to be in the middle of the last week of tax season. So we're going to be down to just a few days. So, it's really important at this point to be doing everything you can to comply with the tax laws. It might even be getting to the point where it'll be too late to completely, finish a return. But as we said, you should at least be getting as much of it done as possible so we can make some good estimates and hopefully file that extension by April 15th if it's needed.
Yes, sir. Thank you, Mr. Armour, and thank you for listening to the podcast. Please hit that subscribe button on whatever platform you're listening on if this is your first time. And we have a YouTube channel now. You can go over to YouTube and search Plan Solutions. You'll find us there, and you can watch the podcast as well as follow along to the personal financial review in the video. And please subscribe there and leave a thumb up, leave some comments or questions, things that maybe you would like to hear us discuss here on the Plan Solutions Incorporated podcast. And if you want to subscribe to the Personal Financial Review, send Katie an email there at Plan Solutions. It's KATIE at plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefor, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.